Good morning. How are you?
Good morning. Great.
I'm going to start off really quick though by saying we are recording this on at 10 a.m. roughly on March 5th of 2025 because I feel like we need the date stamp on what we're about to talk about because anything could change tomorrow. I mean we're in a period of extreme volatility and we know that. But that's actually why we're talking because you and I were having a conversation yesterday and I thought, oh my God, we really kind of need to record this because it was really interesting things that I know about because of you, because you call and tell me these things, thank goodness. But not everybody has that. And it was just interesting stuff about what's going on with the interest rates and where it looks like we're going. So
Yeah,
I wanted to
I
kind
feel
of
like it's a conversation. It's like a continuation of a bigger conversation that's been going on for a while. But you know, certain days, certain things happen that are more or less impactful, and we've kind of gotten to a point to where it seems like or feels like, and there is, things that are happening and have happened that have kind of started to have an impact on the short term. And then, we always like to look out to the long term, the markets do at least. But there's been a lot of recent trends that are really bond friendly, really bond positive. And as that relates to mortgage rates, bond positive means that rates can come down, which we all want to see. And a lot of that stuff we have data to support. So, one of the bigger, broader things is a shrinking economy. We've got numbers that show, personal consumer expenditure decreasing by 0.3% in January. So overall consumer spending declined by that percent compared to a previous period, the prior month, which directly indicates that people are buying less goods and less services and really signifies a slowdown in the economy, right? Less dollars out, there's less dollars in the street. So that's a thing. And that's really bond friendly from um, all standpoints. Markets respond to that, and we see that yields come down, and that takes pressure off of rates, which is a good thing to be able to say. It's a good thing to see. And when I see that, I like to call you and tell you about it because it's noteworthy and has an impact on people that we're talking to and people that we're trying to help.
yeah, because you call me and say, hey, you might want to start talking to your people that are on the fence because it looks like it's time to start looking now because interest rates are could be headed in the right direction.
Oh yeah, yeah. I mean, if I'm the person that's out, if you've looked at properties recently, or if you have an appointment to go see properties, or if you're writing an offer on a property, that's something that I would think is really important to know. And it's been kind of further today. This morning, I woke up and I'm just kind of reading and looking at some things, and we see that, another trend that I would call, positive for bonds is softening of the labor market. Private sector, not we'll touch on government sector, but private payrolls. ADP, the payroll company, reported today that private sector jobs last month in February added 75,000 jobs, which is a lot. It sounds like a lot, but it's significantly less than what they were anticipating of 140,000.
I
So
was going
about
to
half.
say that sounds about half of what I would expect it to be in that 150 range. Okay.
Yeah. So yeah, a sharp miss there if you're looking at an expectation versus a real number, and then compare that to last number. The real number for January was actually 183,000 new jobs. So you see that there's a sharp fall off there again, which supports a shrinking economy, less money out there. That's very bond friendly. I haven't really seen the bond prices yet today, but I would, data like that is something real that's going to have an impact on that. So we look at that. So we talk about GDP, shrinking economy, unemployment or the labor market as it relates to that, and also inflation. So it's really macro look. And as far as inflation, something that I saw the other day since we last spoke, oil. We look at oil, we know it follows inflation directly. If one's up, the other's up, almost seemingly. So oil prices have been down this year so far, which is great. But the other day I saw that OPEC announced that they are going to increase production of oil in the spring and in the summer, effectively increasing supply, which is always good news for the price of oil, right? More supply, lower
Mhm.
cost. But that's really good news too on the inflation front, which is also very bond friendly. So all of those things, are a good recipe for improvements in interest rates. And we saw, we've seen some, we had this little incremental drop or, declines over the last several weeks, several days in
Yeah,
a row, moving in the right direction. But yesterday was really impactful, and hoping that trend continues and that we keep moving along that line.
that's awesome. So, all right. So boil it down. If I'm looking for a house today, it's
Right.
time for me to start getting it's time for me to make sure I'm pre-approved. It's time to make sure that I'm paying attention to the properties coming on the market. Because from my perspective, like you've got the numbers, I've got the houses, and we hit. I collect my data every Monday morning, and my 5 years finally of spreadsheet data that I have starting like the month before COVID started, which I think is interesting. We hit this Monday had just residential properties in Northeast Florida in MLS. We had over 10,000. And that's the first time we've had that in 5 years. That sounds like a big number. And it is, but it isn't. So when I started collecting this data in February 24th of 2020, as it turns out, dumb luck, that was when I started, we had about 7,600 properties on the market. So so we've also increased our population. And by the way, at that time, as agents, we were sitting in sales meetings begging for inventory at
Right.
7,600 properties. Like we
Yes.
were like, oh my God, there's literally nothing to sell, is what it felt like. No, we then, a year or so later found out what it really felt like to have nothing to sell when we were under 2,000 properties actively on the market, which is just mind blowing. So 10,000 is actually a really comfortable number. We've got some supply, which means you've got some choices. We aren't still fully in a buyer's market. I wouldn't say it's a massive seller's market either. It's kind of an even. We've got about 4 months worth of inventory, which is now where they're saying is an even market. We used to say 6 months. Now it's 4 months. I don't know what it is. What I do know is that's a fairly comfortable number, right? We're looking at 2018, 2019 level markets for that. And those were decent real estate years. It's hard. It feels like forever to think back that far, but those were good years. Cantrell. Sorry. Yeah, those were good years. Um, Things were moving. You priced it right. It was a decent house. It was going to sell within a reasonable amount of time, probably 60 days on the market, somewhere around there. Yeah. So this is all good stuff because your interest rates are starting to come down and you've got some options.
Right. Right. That's not a bad recipe, right? To
Not
go.
a bad combination. Yeah, that is not a bad recipe for, okay, let's talk about, home ownership. There's still bond programs out there if you're a first time home buyer. There's good stuff for, I know you and I kind of talked, we're looking at hopefully July for Hometown Heroes funds to be released.
Yeah, typically in
Hopefully.
the summer. I think the legislative session just started yesterday, so that will, I would suspect, be in the agenda over the next couple months to get on the budget. I think I had read recently that yeah, there was a request for another $100 million for that program, and that typically goes into play at least the last 2 or 3 years now in the summertime. So that's really helpful to help new buyers reduce out-of-pocket expenses to get in the house. So if we can couple that with solid interest rate market this summer, it's a really positive spin on kind of what I would compare that to be over the last couple of years where rates have been relatively higher. And these things can change really quick. I mean, we've kind of got to the point where we're at now, but I mean, it just wasn't a few weeks ago that the environment was completely different. So it's kind of important to stay on top of it. There's a lot of things that are moving right now. There's still a lot of volatility, but it's nice when the volatility catches you on a good side and moves you in
Right?
the right direction. And I think there's a lot of tailwinds to kind of carry with that right now, to keep moving into the busier part of the year as it relates to real estate.
Yeah. Well, and, anecdotally, I can feel it. I've been busier than I've been in a long time, and the other agents, I spent a lot of time talking to other agents, and, we have the top office and one of the top offices in Northeast Florida. So I talked to a lot of really good producing agents, and everybody is like, "Yep, my phone's ringing a lot more. My pipeline's growing. Things are." I had Super Bowl weekend. I had 22 people come through an open house, which that is a solid open house, man. That's like I'm usually happy with six. So like I feel like six is a good like yes, and people came out in the last couple of years. That's been a decent number. So yeah, like you can feel the momentum building, and if we've got interest rates going down, that's definitely the wind at your back kind of situation, which is fantastic.
For sure. Yeah, definitely a catalyst to help all of those people out if you're trying to sell a house or you want to buy a house. Sounds like there's houses for sale out there to look at. And yeah, it's hard to ever time the market, but if your timing's right now, you're in a good place compared to any time really, I feel like over the last several months, 6 months at least, and hopefully continues to move in this direction that we're in right now. So
Awesome.
looks good.
That is fantastic. Yeah, so I'm excited to see what happens here in the next quarter, as we're approaching the end of Q1 here.
Mhm.
Excited to see what happens.
Yes, we should stay in touch and talk about
Yes.
it.
Oh, absolutely. I love doing these videos. Um, okay, and I can cut it right there, but I wanted to ask you a question. Like I was doing that kind of because I wanted to ask you a question, and it's one I hadn't kind of prepped you for. I have been seeing some reports, and I don't trust them, so I don't know if they're accurate or not. People talking about people with that people with arms that are coming up,
Okay.
which doesn't like logically doesn't make sense. But they're talking about there's a good portion of mortgages that were lower interest rate, but that had like 3-1 and 5-1 arms. I can't imagine why you would have done a 5-1 arm.
Oh,
Is
okay.
that is that potentially a factor in our market? And because
When you
I
when
don't
you
know
say
this to be true.
okay, when you say coming up, meaning that like someone took it a few years ago and maybe it's coming at the end of the 3 or 5 year period.
Yes. And like
Okay.
why you would have done that, I don't understand. That's why
Um,
I like logic tells me that didn't happen, but I
yeah.
don't know the numbers. And I was like, and I thought maybe it's something you were aware of.
Well, yeah, I would say that, if you go back 5 years ago, then that's going to put us in the spring of 2020. So we're in an
Mhm.
environment where fixed interest rates were at essentially an all-time low.
Right. So
You
I'm just
know,
doing arm.
yeah, so we weren't really doing a lot of arms. I always like to think that adjustable rate mortgages, um, when they're more prevalent and when they were more prevalent, when I got into the industry, they were very prevalent. 2004, 5, 6. And
Yes, I remember those days.
yeah, rates at that time on fixed rates were in the sevens. Um, for more or less, call it the sevens. It had touched a little higher into the eights, and we're in the sixes, but somewhere between 6 and 8% range. But the idea was that we were in a declining interest rate market at that time. And I always like to think that times like that make a little bit more sense to be looking at adjustable rates.
Right.
If so long as they can offer some advantage versus a fixed rate. If you look at them today, if we compare one side by side, a 30-year fixed rate versus an adjustable rate that's going to be fixed for, say, 5 years, the
Hmm.
stock rate on it, they're comparable. And because of that, I haven't seen a whole lot of clients that have seen that as advantageous.
I
Um,
haven't done one.
today. Yeah,
I mean, yeah, I guess I was looking at these number. And I'm trying to remember where I saw it. It triggered me to ask you about it because these are not numbers that I have, and that and of course the sky is always falling, and the foreclosures are it's like this kind of felt like one of those where people go, oh my God, the foreclosures are coming. It's like yes, the amount of foreclosures doubled last year from 1 to 2. Like
yeah,
still effectively none. It's not a significant portion of our market, and I don't expect that it will be anytime soon. Um,
right.
I
Well,
kind of
that's
felt
what
like that was a little bit the same with the arm conversation, maybe that maybe
yeah,
there were a handful, and yes, they're going to adjust, and those people are going to be in a bit of a rough position.
right.
I don't know. but they made it sound like it was like this tsunami of arms coming, getting ready to adjust. I'm like, that doesn't make any sense to me.
Right. Well, that's why it's good, again, good to have these conversations so we can kind of get that stuff out and see what's going on. A lot of times, we talk about all these things that are happening today with the labor market and with the economy. And, there's reasons for why they're happening. So you're kind of getting the news. You're getting the news of what all that is. But I feel like when we're talking about that, we're talking about what's behind the headline, right? Maybe
Right.
a week today you go online, you see, okay, well, mortgage rates are dropping, but at that point, it's old news. The rumors have kind of been swirling around. All these things have kind of led to where we were at, and a lot of the uncertainty that caused large moves yesterday in the bond markets were not so much on the hard data that we talked about a little bit earlier, but more so with risks, perceived risk to growth in the economy because of tariffs. Equity markets with stocks have been responding relatively negatively to fears around economic growth. If you opened up a stock tracker, anytime today or yesterday or the day before, you've seen a lot of red.
Yeah.
And those markets are looking out and they're looking at what's going on today and looking at that as negatives potentially for growth for corporations. So you've seen things along those lines. The biggest sectors that we've seen lagging right now are consumer discretionaries, technology, maybe, corporations looking out and seeing a tighter economy, a shrinking economy, and then considering maybe investment into the next quarters or into next year, whatever it is. So at the end of the day, the stock market seems to be responding very skittish on a lot of the news that's coming out and a lot of the economic data because a lot of it is indicating that things are tightening.
Fair enough. All right. Thank you for and yeah. So all right, on the arm thing, we don't think that's really a thing, is what it sounds like. I don't
Yeah,
think it's a thing. All right. I didn't really either, but I thought you know more about that than I do. So thank you so much. I really appreciated it. Honestly, every time we do this one, I learn something. And I love that you pick up the phone and go, hey, heads up. Good stuff is coming. And that we get to do these conversations.
for
I
sure.
appreciate you. All right. I'll talk to you soon.
Until next time.
Take
Bye.
care. Bye.